This is Don Kaufman, and you are watching the TheoTrade evening video, April 7th, 2021. 20 minutes to go to the cash close here on this Wednesday afternoon, with once again the S&P futures massively unchanged on the trading session. You know, it's days like this, it's just a good thing that we are positive theta. That is, we are selling premium inside of this marketplace. Let's actually break down a little bit of the marketplace, but more appropriately, where we happen to be selling premium and where some opportunities in this marketplace may lie in the days to come. So first and foremost, taking a look at the S&P futures, I want to bring up the volume in the overall S&P futures. With 20 minutes to go to the cash close, we haven't even hit 1 million contracts. Now, for those of you that don't necessarily speak geek in the marketplace, all right, the volume inside of the S&P futures is extraordinarily low. I mean, there's a lot of trading sessions out there where, there's half trading sessions in December where we actually trade more contract size than we're doing today. So there's not a tremendous amount of volume in the S&P futures, and the S&P futures are indicative of hedging activity. But I'm also going to tell you something else. There's also not a huge amount of contract size trading through options. Last night I saw in the OCC report, if you guys are interested in this, but in the OCC report, and that's the Option Clearing Corp, about 29 million option contracts traded. The average for 2021 is closer to 42 million, and just rounding right now. So we're way off in terms of option volume as well. And that's indicative of there's just not a lot of, push, not a lot of oomph in the marketplace, especially on the retail side. A lot of the big brokerage firms out there that I'm still in contact with on a day-to-day basis are stating that their volumes are off quite substantially here, with, again, markets at all-time highs. Now, I'm actually going to give you some reasoning that I talked about on Monday. And Monday evening's video, I was talking about the upper edge of the SPX expected move. This is kind of where we're going to start, the pursuit of why the marketplace just mellowed out after having this, blistering rally on Monday. And the answer is, well, we shot up to the edge of the expected move. Right? And what do we have to do after that? And the answer is absolutely nothing. This line that is drawn on the screen, and this is something I share, on the weekend updates. And that particular line, that's the upper edge of the expected move. And it is uncanny to take a look at this, even on an intraday level. All the trade that has persisted, okay, in the last several trading sessions here now, you got to look at Monday, and then we're into Tuesday, and then here we are on Wednesday. All right, for the most part, all we're doing is actually just chopping around, big slop fest around 40.78 inside of the SPX, and you got to keep that that particular level in mind. That is kind of the happy place for risk this week, and that is only specific to this week. That's where kind of the edge of the gamma risk kind of exists. And that's what we kind of call it the expected move. You guys are actually understanding of gamma risk, but kind of crossing above that, the marketplace could actually start to accelerate once again to the upside. But any sell side activity would bring us right back down, okay, to kind of start point of the week, which is all the way back down to 40.20. And you got to keep that in mind coming into the latter portion, Thursday and Friday. Listen, I'd put all the economic news aside. I'm going to tell you right now, okay, what is likely to drive this marketplace in the next 24 to 48 hours? We're back to the bond market, okay? One of the reasons the marketplace has become this veritable slop fest. When I talk about a slop fest, we're looking here at a 50-50 advanced decline line, dogs and cats living together. Listen, a slop fest, I mean, we're getting some rotation maybe into a few tech stocks. Okay, so what are they doing? Well, they're buying the monsters of tech once again, and Apple's heading to the upside, Microsoft and Amazon, Google had a really ripping breakout to the upside. All of that, though, is for nothing if the bonds start to move again. And that is one of the paramount ideas, okay, in the next 2 days of trade that you have to recognize, right? So if we take a look at this, what we have is a little bit of a break to the upside in the S&Ps, and that's largely predicated on what has happened specifically here in the monsters of tech. But take a look at the bonds. They've just been channeling back and forth, which is really, it's opened up the door for the marketplace to just, to move again, because interest rates, okay, are not necessarily progressing to the upside. That's actually fueled a lot of the tech stocks back. But, okay, the point to understand over here, these bonds start to sell off, possibly threaten into the 153 handle again. And specifically, people, look at the bond product. All right, I know they're at 156 right now. You sell off by $2 or $3 though in those bonds, 2 or 3 points, and all of a sudden, okay, doesn't look like a very happy place to be inside of technology again. You need to really put that into perspective, all right, just the next couple of trading sessions, because it's the bonds that are going to start to rock the S&Ps. With that being said, volatility has come off a little bit, okay, but we're talking negligible amounts. So the marketplace rallies, but I'll tell you what, that rally on Monday isn't really what, sparked volatility to come off. Volatility came off coming into the Easter weekend. For the most part, volatility seems like it's pretty close to a floor here, right around the 17 handle. And I would anticipate volatility probably to bounce back up into the 18, even 19 handle in days to come. Even if the marketplace continues to perpetuate itself to the upside, okay, volatility probably doesn't have that much further to fall at this point in time. Now, okay, completely different note here. So obviously we're watching the bond product, okay? And one of the reasons that we're watching bonds pretty intensely is I've actually been selling some premium inside of the bonds. Why? I'll use TLT for an example. Now, predominantly where I am carrying risk is here in the ZB, okay? So I actually like trading the 30-year US Treasury bond futures, but maybe TLT is a little bit more of a comfortable instrument for some of you. There is still excellent premium, okay, in dem dare bonds, and that's one of the things that's often missed. Like right now, you look at this, like, it's an all-time high. The volatility, the VIX is the lowest it's been. What? The VIX is the lowest it's been since the onset of COVID. I get it, but the bond volatility is still rocking out there. Okay, so we propose to probably sell some premium in the bigger positions I've got on right now. I am selling premium specific in the bond product. But, okay, again, you got to understand that when I say there's a good, it's a good thing we're selling option premium right now. In dead days like this, all that's basically happening is things are just decaying in our favor. It doesn't matter whether you've sold calls, whether you sold puts, okay? You can sell calls. We're rallying. Volatility is coming off a little bit, but the volatility that's coming off, not exactly what you think. I'm going to start here inside of the spiders. Now, the spiders, okay, this is where volatility has gone to die. I mean, take a look at the spiders for just a second. And in some of the shorter duration options, look how low some of the vols have actually gone, okay, considerable. And one of the points that I want to make with this, and again, I'm showing you a product and I'm telling you, yeah, volatility is low. And you go, why would you want to sell low volatility? Okay. No, I agree with you. Why would you want to sell low volatility? One of the things that many, even experienced traders, are getting wrong right now is people like to sell really short duration options. And the reason they like to sell short duration options, okay, is they perceive that there's a better burn rate, okay? But what they're also kind of missing is that there are still excellent amounts of volatility all the way out here. Okay. When I say excellent amounts of volatility, if you went out even 72 days or even 100 days out, just to make a quick point, let's say let's get crazy. Okay. Let's go all the way out to these July options. Let's assume that we actually sold some of the July options. And I've got positions in spiders, and I've got positions in the QQQ, and I've got positions in IWM. But let's assume that you were just going to go out here and you're going to sell some premium, okay, 100 days out. You're actually selling over a 20% volatility. Now, all factors being held equal, let's just assume the marketplace was kind of mellow and the marketplace either rallied, maybe sold off a little bit. Forget about just option decay. Volatility itself, okay, is going to collapse as the option moves forward through time. Like if you go from a 100-day option, and just for instance, let's say we just drop to the 44-day option, okay, volatility has subsided. By how much? You're like, oh, it's 2.5 points. That's not very much. Okay, that's actually quite a bit. So you got 2.5 points. Not only do you have theta burning in your favor, but you've actually got volatility subsiding as well. And this is some of the differential between what we term contango and backwardation. But there is one big boy contango right now in terms of volatility. But if the spiders, ain't your size and you like a little bit more volatility, you go out to the IWM. And the IWM is kind of in stark contrast. Okay, one of the wild things inside of the IWM is the IWM, okay, the front volatility, they're actually relatively high. Okay, so in effect, what we've actually been doing is, well, selling some premium in one product and in fact buying premium in another product. It's actually almost like a version of dispersion. If you guys are familiar with that terminology, a little bit of a volatility arbitrage inside of the marketplace. And the IWM, okay, this thing, it is on the move. Okay, so a last look at this, and this is something that I'll explain in much greater detail, okay, while I'm live here at TheoTrade throughout the course of the week. But take a look at like auto expected moves, and you'll see the IWM is actually approaching the lower edge of its expected move. At the exact same time, take a look at the QQQ. The QQQ is literally sitting on the upper edge of the expected move. And we already know that the spiders, okay, in fact, are sitting on the upper edge of their expected move. So this dynamic is, again, wonderful if you actually understand some of the complexity, if you will, of selling options premium. Because, again, we've got one marketplace headed to the upside, the Nasdaq effectively headed to the upside, but the Nasdaq too. The Nasdaq is still carrying fairly heavy volatility along with it. Okay, people, there is still plenty of premium to sell in this there marketplace. And I will say something about that. Flat marketplace, it's a great marketplace for those of you that do understand the sell side of premium. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.